Welcome to the Trading Market Technicals Morning Call video for Tuesday, February 26th. Big down day in the markets. Dow down 216 points, Nasdaq down 44, S&P down 27. And this was due to an uncertainty of an Italian election, and also a bad Philly Fed number really helped this market decline yesterday. Took back all of Friday's gains. And as of Wednesday afternoon, we had 2.5 days of down days, really pretty much wiped out all of 1 month's worth of gains. And I mentioned that to you as the market steps up higher and higher. And when fear starts to kick in, fear is greater than greed. And as we all know, the markets actually took back all of 1 month's worth of gains. Now, where do we go from here, right? It's a big question. And we are a technical website. However, just to kind of rehash what's going on and what to look for is really important, plays a critical role in sentiment and as far as some sort of a catalyst, right? Could it be a one-day wonder again? Probably, I would say that there is a tradable top here somewhere along the lines. But we did have a hard day yesterday, fall. And believe it or not, although a volume did increase, but it really wasn't as scary as if people looked at when they came home and looked at the news. Markets did tumble, yes they did, but they also just kind of drifted a little bit lower, and then they sold off again into the close. So what's going on here is what really the bottom line is that the Fed has accommodated us since 2009, QE1, QE2, QE3, all sorts of different asset purchase programs, and has gotten the market to relatively all-time highs. Should the market be at all-time highs? Absolutely not. So what are we looking for? Well, Ben Bernanke speaking today, and he's testifying in the Senate Banking Committee. I could almost assure you that all eyes will be on what Ben Bernanke says and what he's going to do going forward. Is he going to pull in the reins on his asset purchase program? Is he going to start literally start stepping away? My guess is that he's not going to say too much, because already the markets are a little bit spooked on what's going on over in Europe. But nonetheless, that is what we're going to be looking for. Any indication from the Fed, are they going to start reversing their monetary policy? That's going to be really big key here. The second thing is what the market investors are doing, and traders, right? If they're convinced that there's no more free money coming, this is going to get ugly, and it'll get ugly really fast, impacting equities, risk-correlated currencies such as the Aussie dollar, the Canadian dollar, and the New Zealand dollar. And that's going to put a bid into the safe haven currencies. Well, right now we do have, as you know, the Swiss franc pegged to the euro. That could actually go away really quick if things get really ugly. Okay, we do have the Bank of Japan intervening with the yen right now. That could also go away. But nonetheless, we have the almighty dollar, which I've been talking about, and has been well bid up since last week. And I'll get into a chart with you as well. Okay, so that's going to be really key. It's going to be very interesting to see what Mr. Bernanke has to say when he's discussing policy. So that is going to be that's going to play a big key role. Once there's no more free money, there's no reason for the markets to be up at these levels. There isn't any reason right now. But the bottom line is that we want to trade what we see. We're a technical website. We're technical traders. And if price is telling us otherwise, you'll get it from the charts. You'll definitely get it from the charts. So bottom line is that I don't think there's much more room for any additional stimulus. I really don't think so. And I do think that at one point in time, this market will finally come to reality and show the world market, right? We are a world economy here, and really get back into where the market really should be trading at. And that's where things are going to get very interesting rather soon. And I always say that's why all of January we've grinded higher since December 31st, 2012, and just about all of February. And as you can see, volatility stepped in last Wednesday, and now things are going to get interesting. However, now, one thing as far as trading is concerned, we don't want to be just plain blindly just shorting the market, right? And that is because that's going to save you from any disastrous losses. So you don't want to be looking just to short the market. Have a trigger in place, have a spot. Let's let the market make lower lows and lower highs and get a confirmed uptrend. A confirmed top that at least that we have a tradable top and that we are headed lower. And I'll show that to you in the charts right now. But just keep a clean palette. Get ready and look to short the market. Now, as far as the longer term investors, which we have, and we also have position traders as well, I've been saying to look to buy protection. Now, protection is getting expensive again already. As you can see, and I'll show you on the VIX. The VIX has spiked dramatically. So puts are now getting to be expensive, and I'll show that to you as well. So if you're willing to ride this storm out, then that's one thing. But I would be looking, or I would have been looking to buying puts for protection. It's money well spent. You could sleep at night, ride the storm if you're looking that this market is going to at least test the highs. Okay. So I just want to show you, as far as econ data is concerned, as you can see here, we have some home numbers coming out. And again, 10 o'clock, Ben Bernanke speaks. So this is something very interesting today. It's going to really affect the markets. No question about it. Okay, now, it depends on what he says, obviously. Take a look at our NYMO, McClellan Oscillator. As you can see here, we do have a negative 49. Now, that does not mean that we are oversold. We still have a good ways to go down. We did close outside of the band again. As you can see here on Thursday, we closed outside the band. Friday, we had a move up, and now we're back outside the band on Thursday. Usually when we close outside the band, you can see these circles, we actually rally here. Okay, same thing. Now we're outside the band. That doesn't mean we can't get followed through and really push down. Then, if that's the case, I will be looking for a tradable bounce here. Remember, markets don't go straight up and or straight down, and we do have a large engulfing candle. So anywhere around that 70, 80, 90 area, I would really honestly look to cover shorts if you're short, and look to really just look for a recovery bounce. And that's what I'm looking for now, is looking some sort of a bounce. And I do think that any rallies should be sold into until otherwise proven wrong. Now, I want to show you the VIX. And as you can see here, here's another reason why I say that we closed outside the band on the McClellan Oscillator, which gives us a buy signal. We also closed outside the band in the VIX. And look at how huge this candle is. This hasn't been this way in I don't know how many months, and maybe even years. We are outside this band. So again, this is a buy signal for the market, at least for some sort of a bounce. Early morning, right now we're up 4.5, 5 handles in the minis. Really doesn't mean much, but right now, at least overnight, in the Asian session has been stable. Europe is actually down, and again, because we have uncertainty with the election results in Italy. So here we have a buy signal. Now, that doesn't mean it's going to happen today, and I want you to go out and buy the market. I just want you to say be cautious. If you are short from yesterday, you're looking for follow-through, I would be looking to tighten your shorts up here if the price starts to gravitate to the upside. All right, the CBOE, as you can see, now we're at 115. So the put options are going to be getting a little bit expensive here. So if you're looking to hedge, really, last week really was your time to hedge. But nonetheless, you could always get a quick hedge out on any rallies here. All right, I want to show you this chart. This is very interesting. I showed this to you many months back. This is the ratio chart of the consumer staples versus consumer discretionary. So if you don't think money's flowing into safe haven safe haven sectors, think again. Here is the consumer discretionary and consumer staples. As you can see, the ratio chart here, we have literally exploded to the upside. Now, obviously, things will come back down again and then look to bounce back up again. We are a little bit overbought here in the RSI 14, and our stochastics are 14.3 stochastic. So, again, something to keep an eye on just to show you where inflows are going. They're going into the safe haven sectors, and of course the U.S. dollar. All right, take a look at our S&P stocks above the 50 day. I had mentioned to you yesterday that we got a sell signal, and this does hold true. We are at 66 right now, so plenty of room to run to the downside. Here's our tick chart. As you can see here, once we make our little highs here and here, we get a little bit of a sell-off, and sure enough, we did, and now we're starting to head lower here. Okay, now let's go into the charts and see where we go from here. All right, now big distribution day here. As you can see, the big red candles, distribution, and look at our green candles. low volume, grind higher. Okay, so we just wiped out literally about 4 or 5 weeks of gains, and now we have this large engulfing candle. Can the can we happen again today? Sure, but I honestly think that the markets will probably try to come back in, at least retrace that 50% candle, just like this candle did here. We did get a little follow through on Thursday. We retraced back on Friday, and then we had this large engulfing candle again. So again, guys, anything can happen, but this is telling me volatility is picking up, telling me that a tradable top is in and or near. So we'll just wait and see what happens with price. Let's see if price can pop up one more time and then fail. And then I definitely think that we're probably headed towards the 1475-ish area in the S&P cash. Take a look at our spiders. We hit this one here to a T, 150, 150. We bounced, we rolled back down, we caught the 149.80. Right to the penny, and then of course we bounced again on Friday, and then yesterday we had a major reversal back down here. S3 is going to be a little bit of support, but I want to show you the volume profiles, and this is why I say this is going to be our really pretty much our spot, 147.20 if it does break the S3. We have a real big thin zone here on a 60-minute chart. Now this is better on a daily chart when you're looking at volume analysis, but big thin zone here. Next big cluster area is really going to come in around 147.20, and that's where I'm looking at a little bit of a bounce up here, fail, and then back down here for a retest of the 147.20, and then the markets may rally into March. And maybe even April, and then I would probably suspect the selling may go away type mentality again, and then pretty have a dismal summer. But again, that's ahead of it. We're getting way ahead of ourselves. I just wanted to think about possibly what might be happening. Look at our MACDs, our RSI, our stochastics, all rolling over on a 60-minute chart. No positive divergence at all. And as you can see on the 30-minute spiders, same thing. All the way, just wanted to show you how we just wiped out pretty much a good month's worth of gains here. All right, S&P cash, CCI told us we're making lower highs and lower lows. As you can see here, we did break down here. 1520 was our resistance area. 1495 was our break. Our target right now is going to be the 1475, which coincide nicely with the 50-day moving average. And as you can see here, again, guys, real little thin zone. This is going to be some big support. 1450, 1475 up here. If we do break that, then I would suspect a test of the 1420, 1400 area of the S&P. So let's just watch this and keep this in mind. So far, so good. I would like to see a little bit of a pullback, a little bit of a back test one more time. That would give us lower highs, and then one more time lower highs, and then you can really get aggressively. You're looking at short rallies. I put a Fibonacci retracement off the top from the December 31st low. As you can see here, 38% Fib retracement would be a 1480-ish. So figure 1465, 50%. Right up in this area here is probably the first target for any real tradable bounce in the market, okay? But again, we could zigzag here, up higher, fail, into that 200, and then roll back down again hard one more time. And as you can see on MACDs and RSI, just rolling right over again. No positive divergence as of yet. Okay, same thing with the 30-minute chart. Just want to show you how ugly the day was yesterday. And XLF, I mentioned to you last week, I'm looking to short banks. JP Morgan and Morgan Stanley are my two favorite shorts as of right now. But again, we need to get into the stock, so that means that we're looking for some sort of a bounce prior to looking to short the two banks. But JP Morgan and Morgan Stanley seem to be one of my two favorites I keep looking at, look to get short in the banking sector. But again, we need some sort of a bounce. I wouldn't be looking to short down here at this time. And it's a little tough because when you have a retracement back up higher, and then you're looking for some shorts, and everything just kind of falls out of bed, and the shorts have gone already, and you're really not looking to short strength in the course of the trading day. So you're waiting and you're waiting patiently, and then all of a sudden the market just kind of gives way and you're not in it, and that's kind of, it's very frustrating once in a while to see. But again, this is a good sign. Volatility's picking up. As you can see here in the diamonds, the Dow Jones ETF, we're starting to break lower here again, taking out this area. Now, one more back test up into the 20-day, and then a break lower would really solidify that a tradable top is in. IWM's risk off mentality, as you can see here, and also again getting back to the high yielding currencies, they also have been decimated yesterday. So just another thing to keep in mind, that everything's starting to fall in line here, that we do have a tradable top here. IYT transports our leader, as you can see here, broke much lower. This is going to be a good line in the sand here, 102.45. I've been mentioning this for the last month or so. So let's see if we could push back, break back higher, and then fail again. And as you can see, our MACD and stochastics have rolled over and just recently just broke. Now remember, don't forget, our NASI summation index on the weekly 5-3 stochastics went on a sell signal last week. So that so far is holding true. Apple, just an ugly, ugly trading stock. That's really what I would put it. I would keep away from this stock. It's not even worth it. I like to see a big flush below 400 before we even look to touch it. Just for a trade, for a bounce, and look at this. We had a 2-day small little bounce and just gave it all up. This is really the line in the sand. It's going to be that 440 area, and then you're going to probably look at the 420 and then the 400, and then all bets are off with a big flush to the downside. Anything below 400 would really entice me to look for, to build some sort of a small position in Apple. Other than that, I wouldn't touch it. It's just dead money right now. And lastly, the Qs. As you can see here, being also held hostage to Apple, but tech was really heavy yesterday as well. Virtually everything was heavy. All right, guys, be safe out there. Remember, keep your stops in place, and if when in doubt, cash is a position, take a step aside and just let the market do its thing until you can really feel comfortable and find something that you like. There's going to be plenty of opportunity. Trust me when I tell you, the markets don't go straight up and or straight down. I don't think you missed anything if you didn't do anything yesterday. Let the markets retrace a little bit. Let's see it fail, and then we can get in aggressively short. Okay? Have a great day, everybody. Be safe out there today. We'll talk to you tomorrow. Take care.